This is the text platform informing the nation on text matters. I'm your usual host, Dumelo Ranau. Welcome to the text platform. In last week's episode, we touched on the subject, the tax implications of bad debts, specifically focusing on income tax and value-added tax. This week, we tackle the same subject, bad debts, and we're extending it to provision for bad debts. But this time around, we look at the deferred tax implications of the two. Now, when it comes to deferred tax, you can either recognize the deferred tax asset or a deferred tax liability. And those are only recognized when there are temporary differences between the tax treatment and the accounting treatment. So the tax treatment will look at what the tax legislation of that jurisdiction says. So in this case, the tax legislation for Botswana, what does it say on the treatment of bad debts and the treatment of provision for bad debts or impairment for bad debts? And then we look at the accounting treatment. What does the accounting treatment say on bad debts and provision for bad debts or impairment of bad debts? Now, when it comes to provision or impairment in tax, they can either be specific or they can be general. So for tax purposes, bad debts and specific impairment or specific provision for bad debts are treated as tax deductible, and general provision or general impairment is treated as not deductible. So what is the difference between specific and general bad debts provision or impairment? Someone may ask. The difference is that for specific, you are writing off an amount for a specific client or specific clients, and you may have intel or knowledge that these guys have financial problems. It's either they've been maybe placed on provisional liquidation, or they are facing some cash flow problems, and you are aware of that, and then you anticipate that they may not be able to pay you based on that information. While the general ones, you apply to a certain bucket, you say, okay, these are over 90 days, so let me just do a provision in case. You do a thumbs up when it comes to the general one, but when it comes to the specific, you are using specific information that you have gathered that these guys are likely not to pay me because of 1, 2, 3 problems they are facing. So that will be the difference between the two. And then, so if it is specific, that means it's deductible for both accounting and tax treatment. So there are no temporary differences, so there is no deferred tax effect. But for a general one, when it comes to the accounting, it will still be deductible. But then when you go to the tax treatment, you will have to add it back. So if you've added it back, that means there is a temporary difference in that year or in that tax year, in such a way that you have deducted it for accounting purposes, but you have added it back for tax purposes. So it creates a temporary difference and results in what you call a deferred tax asset, because you are simply saying I've paid more in terms of tax legislation while I was supposed to pay less from the accounting perspective. So you treat it as a future tax deductible expense, meaning that you are going to be able to deduct it in future once it crystallizes into now a bad debt. So when that now becomes a bad debt, for accounting purposes, you will not hit the income statement, but you will hit the provision by debiting it to reduce it, to show that it was recognized in the future. So the bad debt will go straight to the balance sheet, while now for tax purposes, since you have now recognized it as a bad debt, you will be deducting it in that year. So remember that you cannot deduct the bad debt for accounting purposes in that year, because you would have already provided for that debt in the past. So that's why for accounting purposes you will recognize it in the balance sheet, and you bring it in the income statement for tax purposes, or when you are doing the tax computation, deduct it from as a deductible expense. So that now reverses that temporary difference that was created in the past, as you are now recognizing the bad debt, because specifically bad debts are allowable expenses, as we've already discussed in the past episode, that bad debts are allowable for tax purposes. So you'll be able to deduct it and bring it into your income statement for tax purposes, and bring it from the balance sheet, and then the cycle goes on and on until you've exhausted the provision, or the bad debt provision that is related to that debt that you are now finally writing it off your books as a bad debt. Because remember, a provision, you are just anticipating that someone may not pay you, while for bad debt you are saying, no, this person is not going to pay me. You have some assurance, or you no longer trust that they will indeed pay you. So when it comes to deferred tax, that will be the difference between bad debts, specific allowance for bad debt or impairment for bad debt, and general allowance or impairment for bad debt. Hope that was insightful to you. Continue to subscribe to our podcast. Remember, we are available on various platforms. We are available on Spotify, Apple Podcasts, Spreaker, Google Podcasts, and all your favorite social media platforms, your Facebook and your YouTube. Thank you for tuning in. Have a good day.